Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to be talking about investing in gold. So 1 week ago, BMO ETFs listed our new gold bullion ETF. The ticker is ZGLD. We also listed it in hedged and USD, so ZGLH and ZGLD.U respectively. And this really rounds out our suite of gold ETFs, which includes our equal weight global gold ETF, ZGD, and our junior gold index ETF, ZJG. So this new ETF is really giving investors exposure to physical gold, which is housed in BMO's vault. And today we are going to get into the benefits of adding gold to your portfolio for diversification purposes, as an inflation hedge, and so on, as well as the different ways to gain access and some of the risks that you might want to consider. Before we get started today, a quick reminder that today is all about providing education to Canadian do-it-yourself investors. We are not providing any investment advice or recommendations. I also wanted to give a quick shout out to Danielle, who has welcomed her new baby girl into the world. So she is currently on mat leave and will be back in a year. But for the next year, you're stuck with me. Okay, so moving on to today. Today we are talking about gold. With me today, I have Alfred Lee, Director and ETF Investment Strategist with BMO ETFs. Alfred, welcome back to the channel.
Thank you. Always good to be here.
So let's talk about gold. What are the different ways that you can get access to gold in your portfolio, and why would an investor choose one over the other?
Yeah, it's a good question. I would say you kind of alluded to already. There's a number of different ways in getting exposure to gold. First, and I guess the most logical way is investing in gold bullion. So with the gold bullion ETF, what we do is we basically go out and buy gold. We will physically store that gold in a vault, which is professionally secured. So that's the best way in terms of getting exposure to spot prices of gold. There's also other ways as well. So we've seen in the past that there's ETFs that are based on futures. So with the futures, one of the benefits of having a futures-based ETF is that, there is no vaulting of the gold because you physically do not hold the gold. So you're just using futures in order to try to replicate the price. The challenge, however, is that with a gold future ETF, there's a futures curve. So if it's upward sloping, or what we call contango, every time you roll that contract, there's a lot of slippage involved. So you're not getting exposure to that spot gold price. And then the other ways, obviously, as you alluded to, is getting exposure to those gold companies. So we do have our equal weight gold ETF, ZGD. We also have our junior gold ETF, which is ZJG. So those are a little bit different. You are getting exposure to gold prices indirectly through the gold company. So generally, when gold prices go up, those companies are going to benefit from rising gold prices as well. So, they all have different benefits, but they also have different applications in your portfolio as well.
Awesome. And we came out with ZGLD, not necessarily new to the marketplace of physical gold ETF, but talk to us a bit about what makes our ETF unique in the marketplace.
I would say, one good thing is that, generally, when we launch an ETF, what we want to do is have different currency options available. So similar to, our ETF on the S&P 500, such as ZSP, and the hedge version, ZUE, which we have a currency hedge version. What we did was we launched it in 3 different versions. So there's ZGLD, which is the gold bullion in Canadian prices. So essentially, if investors want exposure to gold, in Canadian dollars, ZGLD is the version for them. We also have ZGLD.U. So if you want that in US dollars, but also trading on the Canadian exchange, that's going to be the version that you want. But the good thing about having it in US dollars is that, say similar to if you hold a gold bullion ETF that trades on a US exchange right now, by having it on a Canadian exchange and as a Canadian mutual fund trust, you're exempt from a lot of the estate taxes. So that's one of the benefits. The other version that we have is also the hedge version. So, obviously when you invest in an asset, you also take on the currency risk as well. So with the hedge version, what we're doing is we're hedging out the risk between the Canadian dollar and the US dollar as well. But I would say some of the other benefits of our ETF is that the management fee, we're competitively priced at 20 basis points. And also, by having that vault in a local, location, so it's downtown Toronto. So just having that vault, in a local location. Also, we provide the serial numbers to all the bars. So just an additional peace of mind for investors.
I think investors are used to investing in, equities or bonds where they know you're holding the securities. But with physical gold, there's actually these gold bars. How are they regulated? Like, how can we as an investor know that there are protections in place? Can you talk to us a bit more about how that works?
Yeah, that's a good question. So as I mentioned, that vault is local, the downtown location. We did bring on one of the most experienced vaulting and commodity trading teams in Canada at BMO Capital Markets. So we do have a partnership with BMO Capital Markets where they do vault the gold for us. The gold is also financially audited as well. In addition to that, with the vault, obviously it's a professional vault. Instead of let's say, for example, if you go out and buy a gold bar at your local gold dealer, you still have to secure those gold bars, whether you hide it underneath your bed or in your safe or whatnot. You buy it through an ETF, it's going to be professionally vaulted. There's security, there's insurance. In addition to that, as I mentioned, the serial numbers to each and every bar we're going to post on our website, so the actual bars are there. In addition to that, we are buying what's called London good bars. The bars that we buy have to meet the LBMA standards just in terms of purity, but also a certain number of manufacturers are acceptable, right? So in order to be London good bars, you have to be on that list of manufacturers.
Okay, that's good to know. And then there's a difference between allocated and unallocated gold, right? And we're fully allocated. Can you explain that to us a bit more? I think that's interesting.
Yeah, it's a good question. I mean, this is something that I found a little bit confusing, years ago when we're doing research on gold. But there's allocated and there's unallocated, as you mentioned. So, when we go and buy gold, the gold bars that we are buying is 400-ounce bars. 400-ounce bars are not cheap, right? So, the price per ounce right now is, $21.50 per ounce. So 400 ounces is going to be very expensive. So when we get a creation order for an ETF, what we have to do is we have to physically go out and buy those gold bars. Depending on the creation, sometimes we don't have enough to go out and buy, an exact 400-ounce bar. So let's say, for example, we have enough to buy 450 ounces, for example. 400 of it we're going to buy. That's enough for one physical bar. So that's going to be known as what's called allocated. The remaining 50 ounces where we don't have enough to buy a gold bar, that's going to be put in what's called an unallocated account. So we're still getting exposure to gold. We just don't have enough to buy a physical gold bar. So think of it almost as, an IOU account where we physically, we own the gold and we're getting exposure to the gold prices. But just when we get enough to buy another 400 ounces, then that unallocated becomes allocated.
Okay, good. Yes, that's good to understand, I think. I alluded to some of the investment opportunities with gold, but walk us through why someone would add gold to their portfolio.
I think it's a good diversification element to your portfolio, right? So after 2022, we've had more and more clients ask for alternative exposures. So in that year, obviously as interest rates went up, stocks and bonds became increasingly correlated. So your typical 60-40 portfolio, which is supposed to provide you with that balance, that 60-40 portfolio unfortunately did not provide the safety that a lot of people anticipated in 2022. So after that, or in the wake of that, a lot of investors now are looking for alternative exposure. So looking for asset classes outside of stocks and bonds to get additional diversification. So assets that are less correlated to traditional assets. So gold is typical, or tends to be one of those staples in that alternative bucket. So more and more investors are looking for that gold exposure. What we find is historically gold tends to have a very low correlation with stocks and bonds. So typically when people try to fill that alternative sleeve in the portfolio, gold tends to be one of the go-to in that sleeve. And as a provider, what we want to do is provide investors with all those building blocks in the portfolio.
I think a lot of the alternatives too are typically higher risk, and this gold ETF is rated medium, so it's a good asset to bring into your portfolio for diversification for sure. What is your outlook as our ETF investment strategist? What's the outlook for gold currently?
I think there's a lot of both technical and fundamental reasons to own gold right now. So obviously, I think a lot of investors, look at the price of gold. It's hit an all-time high, $21.50 an ounce. The good thing is, from a technical perspective, so if I put my, technician hat on a technical basis, that tends to be supportive over the short term. So when you look at gold over the last 3 to 4 years, it's kind of hit that ceiling of $22,050 per ounce, and it's failed to break beyond that level on 3 occasions. So this time around, it did break beyond that resistance level. And from a technical perspective, and a lot of people trade gold on a technical level, that tends to be perspective, or tends to be constructive, because usually when something breaks above a resistance level, there comes on the back of that a lot of technical buying. So we potentially get that, but beyond the short term, when you look at it more from a fundamental perspective, I talked about, a lot of investors adding, that alternative exposure, and gold being one of those go-tos. There's a lot of fundamental reasons, right? So central banks right now have been loading up in gold. So if you look at the data over the last 3 to 4 years, central banks have been buying a lot of gold. And the reason why is because, they typically hold, fiat currency, so other currencies in their reserves, in order to diversify, their reserves. Now, however, obviously the last 3 to 4 years, there's been inflation. So a lot of these central banks have wanted to diversify into gold in order to better preserve the wealth. In addition to that, there's been a lot of this, quote unquote, de-dollarization talk. I think right now it's kind of more headline risk, but you do have, the BRICS nations, for example, talking about creating a unified currency. And right now, as the BRICS, they add more and more countries, and a lot of these countries that they are talking about adding, to the BRICS are pretty large economies. So what they're talking about is creating a unified currency that is potentially going to be backed by gold. So that's going to be supportive of gold potentially over the long term as well.
Awesome. And then from a portfolio construction perspective, you touched on how it can be used in sort of an alternative sleeve of your portfolio, but what does that look like? How does an investor determine how much to allocate?
Yeah, so it really depends on, what the individual investor, obviously, but, when you add even a 5% allocation to gold in a portfolio, so let's say if you take, 2.5% allocation from both your equities and your bonds, historically, based on historical data, what you find is that gold typically improves the portfolio, not just from a return perspective, but also from a risk perspective as well, right? So you get slightly higher returns, slightly lower risk historically. And what that obviously means is that your efficiency numbers, so things like your Sharpe ratio, your overall portfolio efficiency is going to improve. So that's why we say, even though gold has hit an all-time high, some of the clients that we spoke to have had kind of reservations in terms of adding it to your portfolio. But what we kind of point to is, don't look at so much of the price, but look at, the benefits it includes or it provides to your overall portfolio when you just add even the 5% allocation.
So more of a strategic allocation, not necessarily a tactical play.
Right.
All right. Well, thank you, Alfred. That wraps up another great week of ETF Market Insights. I think you've done a great job of illustrating the benefits of adding gold to your portfolio. It's clear it's an excellent portfolio diversifier, and there's some interesting stuff going on in the markets right now where it makes sense. Next week, we are going to have an episode all around the changing demographics in Canada. So we're going to have Alain Desbiens, one of our Quebec-based wholesalers, walking us through a ton of great research around how this landscape is changing and what it means for you as an investor. So thanks again, Alfred, and we'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.